Okay, guys, and welcome to another episode of the YouTube mentorship program. This will be our first live stream session where we'll talk about liquidity and bias, escaping the Russian roulette. Looking at this, so good afternoon, guys. Sorry for that breaking transmission. We'll be talking about liquidity and bias, deviating from the Russian roulette. And we'll be looking at how to frame liquidity for organizing our bias, how to analyze the week and down to the lower time frames. And what's a Russian roulette, first of all, because I'm very sure you guys will be wondering what's Russian roulette. Russian roulette is just a game of chance. It's a very deadly game of chance whereby a bullet will be placed inside a chamber. And when that bullet is placed inside the chamber, then it's going to be rolled. The chamber will be closed, and then each person will put the gun against their head to shoot. So, how does it apply to Forex? Without understanding the premise of how the market is going to devolve or how the market is going to go, some traders play Russian roulette with their trading. Some traders play Russian roulette with their trading in the sense that the two things that I've always told you that the market does is either it seeks liquidity, that price does, is either it seeks liquidity or it's balance and imbalance. That's it seeks fair value. So it's either it seeks liquidity or it balance and imbalance. Those are the two things that the market will ever do. Those are the two things that the market will ever do, no matter what. Seeking liquidity or balancing an imbalance. So, but traders that have been trading and don't understand the market premise, don't understand why the market does, why price does what it does, are indirectly playing Russian roulette with their money. They're indirectly not sure of what to do and then just gambling. The way I've been taking this mentorship, I'm like fine-tuning it to make it so easy. In the sense that if I break down the plan for you, you find out it's really easy. Just know where your weekly bias is, your weekly and the daily bias. Just know where your week is targeting. If it's targeting a particular liquidity point or seeking a particular fair value, just trade according to that direction on the daily. If you see opportunity each day, that's the trend you should follow. That is just the trend you should follow each day. It's not rocket science, it's not Aikinashi, Ichimoku things. It's not about forming trend lines. Every market is targeting a liquidity point or seeking to balance and imbalance. Just trade according to that direction for the week. And if it's just 2 to 3 trades you take per week, they will be high quality trades. You don't have to become a machine gunner where you take like 50, 100 trades in a week. You just have to be a sniper where you take 2 to 3 high quality setups and you are done. It is not hard. It is not hard at all. But when you don't have the premise or the idea of what the market wants to do, even if you learn from any guru and they tell you, oh, this is an A+ setup, if you don't have an idea of what price wants to do, yeah, you see bullish setups, you see bearish setups, you see bullish setups, and then you discover they fail on you. And one thing you should all know, one thing you should all put in place is, no matter what, if for the week the market is going to target a particular liquidity point, or during the day the market is trying to target a particular liquidity point, if the price is trying to go up during the day, every of your bearish bias will fail. Every of your bearish setup, every of your bearish apparatus will fail. And if the market is trying to target a sell side liquidity, price is trying to go down for the day, every of your bullish apparatus, every of your bullish setups will fail. So it doesn't matter that, oh, before the London session or during the London session, or most likely before the London session, the market is having an uptrend. If the market is targeting a particular liquidity down, all those uptrends will fail. All those continuous trends would fail. It's as easy as that. And then forming bias now. Forming bias is where I've spoken with some traders and what they tell you is, oh, it's just 50-50. The candle will either be green or red. It's easy. Yes, the candle will either be green or red, but if you can't fully form, if the candle will be green at this particular week or red at this particular week, then you're going to fail. The candle can be green this particular week and then red the next week. And you can't keep gambling or rolling the die and say, oh, this week will be green, this week will be red. There must be a premise of why price should go up or should go down. There must be a particular premise, there must be a reason why price should either be going up or going down. You can't just keep having assumptions that, oh, price will keep gravitating up or going down or doing this or doing that. No. So there must be a particular reason why price must go up or go down. And I've told you the reason. I've practically given you. Is either they are targeting a liquidity point or they are trying to balance an imbalance. Those are the two reasons. Those are the two reasons whatsoever that price will go up for. Targeting a particular liquidity point or balancing an imbalance. It's that easy. It's not rocket science. It's not something that should really be hard. Now let's take a look at how our liquidity and bias come into play. In the last video I explained with practical aspect of how I arrived at a bullish bias for the last 2 weeks. I just showed the examples for the last 2 weeks. For the dollar, this is the DXY chart, the dollar index chart, and this is a weekly time frame. I showed you that, and I showed you why and how it goes for the week. For the dollar now, we are targeting this particular liquidity point. I highlighted it out, I showed you, I explained how they failed here in the last video, and also how they failed here and then went all the way down, tripping traders into thinking they are targeting this particular sell side liquidity and then going back all the way to take out this buy side liquidity. It's that easy. This is the particular liquidity being targeted. My bias for the week will be, let's see longs to take out this liquidity. If it's going there, there's a trader that keeps saying, if it's going there, if it's heading towards that direction, most likely to get there. That's how price is. So all your prayers that, oh God, let price fall back, maybe you have taken a wrong trade and then you are now seeing price heading away from your direction, and then you keep praying, let it fall back, let it go back to my direction. 95 to 99% of the time that prayer will not work. It will never happen. You see traders praying that it should head in their direction, it should just go according to their plan. No. Now, we're going to be working from the 1 week now. I'm going to be taking the last 2 weeks, and then we'll be working it down up to the early. And I won't be working on the DXY because I don't think any of you trade the DXY, so I'll be working it down on the euro. Obviously on the euro, on gold, on pounds, and on the Nasdaq. And market dynamics 101 states, if dollar is going up, foreign currencies come down. It's that simple. Normal market dynamics, if dollar is going up, foreign currencies go down. So that's it. So let's go to the euro chart now. For the last 2 weeks, I've highlighted this particular sell side liquidity. Let me target. For the last 2 weeks, I've highlighted that sell side liquidity. And I was anticipating that sell side liquidity heavily to be tagged. I was really anticipating it and waiting for that sell side liquidity to be tagged. And watching that sell side liquidity for the past 2 weeks, my bias on the euro will turn to being bearish. Market dynamics 101, I'm repeating it again. If the dollar is going to be bullish, then obviously foreign currencies will be bearish. So for the last 2 weeks, you have seen the euro going on a crazy bearish run to take out this liquidity point. And since you have seen it going on a crazy bearish run to take out this liquidity point, then how will I internalize this? For the last 2 weeks, if we go to the daily now, with the weekly bias of being bearish, and then we are going to the daily, all I'll be targeting in the daily will be where will be the next drawn liquidity, which is this, and then how will we run towards it, and then any point of fair value that the market might want to rebalance, any imbalance the market might want to rebalance, those will be what I'll be highlighting. The last 2 weeks, Monday started with a bearish run going down. That was 11th of November. So I'll be highlighting from the 11th of November down to 22nd of November. I'm expecting bearishness till we reach this liquidity target. That's my weekly bias, so I'll be trading according to that. I'm not saying every day will be a bearish day. I'm not saying we'll keep printing red candles every day. My weekly bias is I'm only looking for trades for the week. Till we get to this liquidity point, I'm only looking for sell trades on the euro. Bearish trades. So with that being said, this was Monday, the market opened here. The next thing you must also recall is there's also a form of liquidity that is like a low hanging fruit. That form of liquidity in the sense that previous days high the high stroke low so this form of liquidity whereby you target the previous day's low. If you are bearish, you target the previous day's low. If you are bullish, you target the previous day's high. So since you are bearish, this was Friday, November 8th, and then we opened November 11 on Monday at this point. At this point. When we opened at this point, the market first went up and then came heavily down. Previous day's high, that was Friday. The low of it, previous day's low, this is it. You can frame a trade, look for trades that will pan out and take out this previous day's low, and then you are done for the day. And then there is an equal, then looking a bit to the left hand side, there are equal lows as of this point. Equal lows. Equal lows. These two. They are equal lows. We are expecting our weekly trend is let's go down all the way here. So if we are going down all the way, then definitely we are going to take out this and this. So since these are equal lows, this can also be another target that you might expect that Monday to take. This one and this low. And obviously they ran it through. So you can frame your trade up here and then target this for the day, and then you are done for the day. You can also, if you are more advanced, you might anticipate the bulk of this move. But what I'm trying to teach is you don't need the bulk of this move in order to have a successful day. You can just target the previous daily low and then get that and you're done. Then the next day you do that again. The market opened on Tuesday, November 12th here, went up a bit. All what you do is target the previous daily low. This is it. And then you are done again. And then you do that again the next day. The market opened here, it went up. You are looking for a bearish run. Look for your bearish apparatus or your bearish setup that targets the previous daily low, and then you are done. And then Thursday, the market opened, went up. Look for the same thing, the previous day low, and you are done. So it's not rocket science, it's not really hard. It is not something that should be brain tasking, should be really difficult to do. All you just have to do is target the next low, target the next low, target the previous daily low, the previous daily low, and you're good to go. And then as you keep gravitating all the way down, you keep gravitating to this liquidity point. To this liquidity point, as you keep gravitating all the way down, the next thing you should take cognizance of is there, as you keep forming all of this, is there any imbalance that we are dropping, that we are putting in on the chart? There is one. This is it. There will be something of a future reference for us going back. This particular imbalance, we might anticipate they will come forward for it. And that was just Friday did. So Friday, you might not have any bearish apparatus to send you all the way down here. And then you hold your hands and you're done for the week. You got something here, here and here, 4 days straight, and then the 5th day you are not getting anything. It's there. And mind you, after the market closed on Friday, you go back to your weekly chart again, and then for the next week, that's this concluded trading week, we are still not yet at the liquidity point, the sell side liquidity point here. We have still not gotten it. So where will we anticipate again? We keep anticipating bearishness again. Bearishness all the way to take out that liquidity point. Bearishness just to take out that liquidity point. It's not hard. It's not something that should be really tricky. Immediately you see this, and we are targeting this particular liquidity point. This is it. That hold low that was left as of October 2023, that was what Euro came to take out, November 2024. So targeting this liquidity point, all we just have to do is each day again we go back to do what? to look for bearishness on the daily candle. On Monday 18th, we didn't have that. The market opened and went straight up. You won't have much of a bearish trade operators here. The market just gravitated upward. We are still going to check it on the hourly, so you see it. And then on Tuesday, we saw them decussate into this imbalance. When we get to the fair value gaps class, you are going to really appreciate this. And then Wednesday, we started seeing drops in prices. Price going for lows. Wednesday, we went for the low of Tuesday, previous daily low. Thursday, we went for the low of Wednesday. And then Friday, when Thursday closed there, I was so anticipating this on the Friday. And I was anticipating it in the London session, and it happened in the London session. Friday, we went for the low of Thursday, and then to our final terminus, what we have been expecting for the past 2-3 weeks. This sell side liquidity. That sell side liquidity. We went and got that. Going by that again, if we are repeating that again, it's so easy. Then we take the last week. Now, we are targeting this liquidity point. Market is gravitating to take out this liquidity point. This one. That they took out this ending of this trading week. If by insight, let's say we don't know what's going to happen as of this point. Let's say we don't know what's going to happen as of this point. And then we are gravitating down to take out this. This is a liquidity point that we'll be watching out for. And after they engage this is the next one. This is it. They have broken every bullish structure that can send us back up. Has been broken. So obviously this liquidity point will be gotten. Because all this terminus, all this pathway, this retracement, and all this, they have broken it. They have retraced. And then where do you expect? This. So it is not hard. It is not rocket science. It is not something that should spike you or should make you afraid. This is just the pathway. If you go back to the lectures of CRR, expansion, retracement, expansion, retracement, expansion, retracement, expansion. This is actually a retracement, then more expansion, then a reversal, then a retracement, then reversals. It's as easy as that. So, with the anticipation of this liquidity point being gotten, that we'll get there, for the next week, I'll be bearish. And that's what they targeted. After getting that, this is the next. There's no bullish operators that can send us back up here. There's no bullish operators. There's nothing within here that can send us back here. They are fully engaged it when they retrace down all the way here. Here, they are fully engaged that order block. And they have made a new high. And now they have reversed all those moves. So this liquidity point is feasible to say we are going to say it. So with that being said, the next week I'll be anticipating another low being formed. That's it. That's how you internalize the week. And once I internalize the week like this, all I just have to go is to the daily. To the daily and start looking for bearish trades till we get to that liquidity point we are targeting. Now let's go to the 4 hours and then we see the week from the 4-hour frame. So the start of the week was, I think, Sunday evening. I'm using New York local time, by the way. So the start of the week, Sunday evening, New York local time. If I map out, I can confidently say from here, from this particular point all the way down here, all of these moves here, all of this, they are all retracement leg. And then from there down. That's it. These are low, this dealing range, retracement, and then down. You can keep saying, oh, the market is forming slight uptrend there, that they should keep going up. The week is showing us that this will be gotten. If the week is showing us that this will be gotten, the only time I can be thinking of, oh, do they want to go back up a bit more, is if they have taken out this particular high, this one. They are taking this out, I would have been thinking maybe here or here, it might keep going up to maybe target here. But as long as they are within this price leg, from here to here, all of this is retracement. And so, on Monday, I'll be anticipating a likelihood of dropping down. And that was what I anticipated. So, I'll be only looking for bearish operators. Bearish operators. And how will I be looking for bearish operators or bearish setups? I'll be looking for, if they are on an uptrend, on a mini uptrend, I'll be looking for a break in market structure or a market structure shift. And then I'll start looking for the retracement, then the reversals. Listen again. If they're on a mini uptrend, I'll be looking for a break in market structure shift, and then or a break in market structure, a market structure shift, and then a retracement, then reversal. So if we map out the pathway from here, we can safely say this is an uptrend that was retraced into, then uptrend, the retracement leg, that's the expansion, then the retracement, then another expansion here, then a retracement, then another expansion, then a reversal of that expansion leg. A reversal of that expansion leg. Immediately a reversal of that expansion leg, what do I expect? I expect from there, I expect a retracement, then more expansions going down. And that was what they did. Where's the market structure shift? Where's the market structure shift? Is here. That's the market structure shift. So if I hide the chart, like this is what I'm saying. This is exactly how it's formed. They first had a mini uptrend. That was from Thursday, Friday, then till Monday. They did that even till Tuesday. They had like a mini uptrend. protecting lows. In an uptrend, they protect lows. So this low was protected, this was protected, this was protected, this was protected. Then a reversal of this expansion leg. This is it. This is the expansion leg I'm talking about. And then this is the reversal of the expansion leg. Uptrends, keep generating uptrends, new legs, and then reversed that trend. Reversing that trend, I'll be expecting a retracement, then more reversals. This is where I'll be looking for my trades, starting from here, from Wednesday. Starting from Wednesday is when I'll be anticipating and looking for trades. It's as of that point that I'll be expecting any of my trades to form. With that being said, that is exactly how it played out. After this market structure shift, they made a slight retracement, then started going down more, gravitating down. This first becomes a liquidity target I'll sort out for. Then this becomes another liquidity target I'll be sorting for. These two first, after this market structure shift, and then going down. This retracement leg, I'll be looking for trades, sell trades in this retracement leg to look for this liquidity target, and when we get here. So let's go to the 1 hour. Going to the 1 hour, after the market structure shift, was a bearish anchor or a bearish setup we can see here. The bearish setup we can see here is this fair value gap. This fair value gap. The old students, they are also in the class, they can attest to this. This is what I'll be looking for. I love fair value gap so much. And then these last two series of up close candles, they are other blocks. When we get to that class, I'll also be explaining. But this is the bearish anchor. This is where I'll be looking for my sell trades. And then I'll be selling based on when the London or the New York session opens. That is it. I'll be selling based on when any of the session opens. You won't see me trading the Asian session, no. And you won't see me trading before the London session. When the London session opens, that is when I'll start planning my trades, start anticipating where to go. So with that being said, this is an opportunity. And how do I internalize the 1 hour? During the retracement leg, I'm looking for the uptrend that if I'm expecting price to be bearish, then I'm looking for the uptrends that will form during the retracement leg. I'm looking for the market structure shift. I'm looking for displacement to the downside to signify the start of what price wants to do. And these are displacements. So on Wednesday, after they did this, Thursday they retraced all the way, and then by Wednesday they did this, and then Thursday they started dumping it. So this is an opportunity. On Thursday there's a trade I took here actually around there. We didn't get here. I closed maybe somewhere around there. Yeah. and then I waited again for the London session, for the New York session, sorry. The New York session, I was expecting, oh, we shouldn't go higher than this retracement level, higher than this, and then they were spiking and then gave up the ghost, and then we saw this taking out 2 straight liquidity points. And from there, Friday, we didn't get, on Thursday, after they took out these 2 straight liquidity points, we didn't get to that final liquidity we were expecting on the week. We didn't get there. So I was mainly coming with the premise of we should get there on Friday. So when London session opened, we first saw this spike move up. All this spike move up is just something I'll internalize as then spiking into a bearish setup, entering a bearish setup and then giving up the ghost. There are plethora of beautiful trades inside this Friday. So with that being said, there's another liquidity point here that you can target. Here, these are equal lows. Here and here, these are equal lows. So before London opened, they generated liquidity here. They generated liquidity and then neutralized it. Generated liquidity, neutralized it. Support and resistance traders. Where would they come in? Oh, the market came here, bounced, came back here, bounced, even gave them the third time, bounced, saw this strong move, they start going for longs. And then coupled with this low, they'll think, oh, this is a big support, going for longs. Where will stop losses be? Below these lows, even below here. And then they all get their clocks cleaned. All here. So, getting their clocks cleaned all here, the market is going to drop and dump all over them. And then when it dumps all over them, this is the final target you're expecting for the week. Once you get this, you are done for the week. You can close up your terminal. Let's now look at trades that happened on Thursday and Friday on the euro. See how we fine-tuned it and brought it down from the weekly frame down to the hourly frame now. Then we are going to the 15 minutes. And then we are seeing Thursday first. Going by Thursday and looking at these last 2 down close candles before this round, this is a bullish scenario. This is a bullish apparatus. These are bullish order block, then this fair value gap. When we get to those lectures, you get it. But at the end, from what I've taught you, the markets formed all this. Just take all of this as a move, because all this going down, they aren't true retracement of this leg. Take all this as a move and then they reversed it and then retraced. Immediately they retraced. What do you expect? More reversals. Look at it very well. If you take all from here to this top, as a whole price leg, they reversed it and then retraced and then more reversals. Yes, that is a whole leg. If you don't get it well, then I'm going to hide the chart, then you see how that line forms. Expansion leg, they reversed it immediately. How did they reverse it? The whole expansion leg from below, they came to take it out. That's it. And then retraced that reversal leg and then more reversals going for the downside. And now this is where time and price pairing comes in. This is where time and price pairing comes in. During the retracement to go for more lows, when did it occur? It occurred during the London session. I'm using New York time, New York local time. This occurred during the London session, exactly during the London session. It didn't occur during the Asian session, it occurred during the London session. This big displacement occurred during the Asia session, and then there was a news to also push it down. But this occurred during the London session, the retracement leg. During the London session, then more reversals going down. Breathe that in again. Time and price. It's until when the time is right. It's until when the time is right, that is when price will do what it has to do. Take it in again. It's until when the time is right. That is when price will do what it has to do. Breathe it in again. Is until when time is right. That is when price will do what it has to do. That is why you don't just see this chart just pinging anyhow. It's until when time is right, that is when price will do what it has to do. That is it. That is it. All this leg was retraced and was reversed, and then price retraced back. Immediately price retraced back, price retraced into a bearish scenario and then dumped. I participated in this trade, this particular one exactly. And then got as low as here. I think I eventually took majority of the bulk here. Because I was targeting a London didn't give me then. I waited for New York. New York just paid away. But I think I took lead to here. I took lead to here to target justice. And then going to Friday now. Going to Friday, and the same vein, we are targeting this low. Targeting this low, this particular low. Check it out again. Until when the time is right, that is when price will do what it has to do. All this was when the session closed. And then look at London. When London came into play, they formed something of a Judas swing. Judas swing in the sense that price will first form a fakie. Fakie in the sense that they will go up in the opposite direction first of where they want to distribute to. So if price wants to eventually go down, they first go up They will run all the way up, trip traders into thinking, oh, we are going all the way up. Breakout artists will start pinging trades in, putting their orders in. Breakout artists. Then uninformed money will also be putting their orders in. Then they'll start drawing, oh, this displacement, and they want it to retrace and then go more, without knowing where the bias is, without having a bias, without knowing why price wants to go there. One thing I'll keep telling people, and I'll keep saying and preaching, is no matter how much everybody keeps shouting, oh, and this market is heavily manipulated, is this, is that, this market is structured. Each and every input that you see on this chart is perfectly structured. So you don't just expect, oh, them running up and then coming all the way down. Why did they do that? They shouldn't be doing that. You are not printing the frigging candles. You see traders talking one particular mindset that, oh, once they see this sharp run, then they should keep going up more. And then they trade according to that direction, and majority of the time they lose their money, because price always tend to form this. Look at how many times you have seen it. Thursday we saw something like that. This move up, London session, move up, then sending it down. Friday, London session, this run up, then dropping it all the way down like old school. And then there'll be some people erroneously tagging this red candle a bullish setup, this setup a bullish setup. If it's a normal chart and then the bias is being long, this is a valid setup for a long. If the bias is long, this is a valid setup for a long. But the bias is bearish, is to look for shorts or sells. If it's to look for that, then every of your bullish bias will fail. I'm a big advocate of, if the market wants to go down, your bullish bias will fail. If the market wants to go up, your bearish bias will fail. It has always been that way. It has always been that way for a long time. If the market, if the algorithm or price, anything you want to call it, is going down, if price wants to see do price discovery and go lower, or anything you want to call it, if there's a price discovery going lower, if price is looking for crude oil, every of your bullish bias will fail. Yes, you can call it this a bullish bias. Now, why did it fail? You saw the market going all the way like this. Before the session, you saw the market running all the way up. And then they came back down and then formed something like this. This is normal. This is a normal thing for the market to do. And then you're like, oh, this should be a bullish bias then, a bullish setup then. You look for the retracement to go up more. No. If the bias is a bearish bias, if the algo is looking for down prices, every of your bullish bias will fail. They'll form something like this. They might even give you a slight giving up, maybe pinging it all the way and then throwing it down like old school, maybe retracing back here and then sending it more. And this particular setup is always sharp. The way they send it back down is always sharp. Why is that so? Because of opportunistic traders, because of breakout artists. For them not to quickly leave their trades. Because if they just start pinging around there, they'll keep having up. they take their money fast. And how do they take their money? If this is a breakout, then believe me, majority of traders, majority of breakout artists or support and resistance bullshit traders will be placing their stop loss here. Anybody that takes trade here or is expecting this retracement leg and then they get pinned here, majority of the stop losses will be here. Yes, majority of the stop losses will be here. We can. And majority of the stop losses will be here. There will be sell stops here. There will be sell stops here that will they will buy into in order to close their trades. All these sell stops, they will buy into them. So it's not Aikinashi, it's not Ichimoku, it's not magic or something. That is how it just is. That is how the market just works. And fine-tuning this Thursday again and Friday to the 5-minute frame, because I go as low as the 1 minute sometimes. Sometimes I might just feel like taking my trades on the 5 minute and be done. But there are times when I go as low as the 1 minute, look for my setups there and then take that. Fine-tuning it on the 5 minutes is almost the same, just more candles. This is it. This is a bearish setup. Ping into this, sell into this, and then watch how it looks for crude oil. Same thing on Friday. Bearish setup. Look at the displacement that followed. Big displacement, retrace into it and sell off. That is it. It is not hard, it is not something that is so difficult. It is not something that should be so hard to do if you follow the premise and with more experience. If we go back to the weekly and then look at gold. We go back to the weekly and then look at gold. This is where I really traded for the week. I really traded gold because gold was just giving me exactly what I wanted. How did I engage liquidity here? How did I do? And one thing is, the way I engaged gold, I told, even on Friday, I just told you a snippet. I just gave you a snippet of what I was expecting on gold, and then it's panned out exactly. It's all on the group. For those that in the mentorship class, it's all on the group. Looking at gold, I'm just going to draw this part out. A retracement here, then they formed they expanded upwards. Then after that, we saw this, reverse that. So obviously, I'm expecting a retracement, at least a retracement. That was why I was bullish on the gold for the week. That was the main reason why I was bullish on gold for the week. And coupled with the fact that the previous week before that, we entered this fair value gap, and I expected us at least to push up. So those two things, they rebalanced an imbalance, and then I was expecting a retracement leg. Obviously price can't just keep going down and down and down forever. So since I was expecting a retracement, for my weekly bias on gold was bullish. I had a bullish bias on gold for the week. So going to the daily, I was just trading according to that, and then gold did all of that. Straight 5 days of being bullish. My first target, very first target, if I'm to be like a new trader, my very first target would be the previous day high. If I'm bullish, I'm expecting my first target obviously to be the previous day high. Then after that, to enter into this particular imbalance. Then after that, to enter into another imbalance. Yeah. And then sufficient enough to go for this. Those are my target for the week. So on Monday, I was expecting a bullish bias on gold, and since I was expecting a bullish bias on gold, all I just did is I went straight to my 1 hour on Monday to just keep looking for that bullish scenario, that level of bullishness. And then look at how gold formed. They gapped higher on Monday and then took out my previous day high. This is it. After taking out my previous day high, they ran for the next point, the fair value gap, the imbalance. They ran for it. And then we are fine-tuning that. This is the daily fine-tuning. You want to fine-tune it again. This is where it actually is. Yeah. So it's somewhere around here. So they ran into it, and then they retreat, and then they send it up more. I'm expecting a long at least here first on gold. So this retracement leg, this became an opportunity for me to do what? I first watched it. I didn't pick up any trade here because this is obviously not a session open. So I didn't pick up any trade there. I watched how this panned out. They took out this high to confirm more uptrend. This high is 2,597.280 and the high is 2,597.350. They took out this particular high, but it's so neat. But they took it out. So obviously I'm not expecting gold to go down more. So I just expected this retracement. This was where I took my first trade on gold for the week. This point. And I'm going to break it down when we get to the lower time frame. And what was the anticipation? The anticipation was 1 year and then here. Why here? I expected this. Since I'm anticipating we go as high as here, I'm not expecting this imbalance and this fair value gap to be something that will send us down. So I expected it to be invalidated. At the point of invalidation is here. So this retracement leg, I was taking longs here for this first, and if you had more fuel to get to the top of this, that's the buy side liquidity there, and then more fuel to get to another buy side liquidity. We gold all targeted. So this was my point of trade to get there, and then after they ran all the way and took this out, I was expecting maybe they will come back inside here or here where I can take another trade to get here. They didn't, and then they ran it all through. Then market closed, the New York session closed, and I was done. Now, another beautiful day opened. That was Tuesday. They missed during the Asian session and before London opened. They missed this particular liquidity point here. Let me open it very well. They missed here. They couldn't take out that liquidity point. So obviously, and then they came down. At 2, they came down. Obviously, they came down to do what? Rebalance and imbalance. Rebalancing and imbalance, I'm expecting longs again. I took another long position here to first take out these liquidity points and enter this daily target first, which they did. Now the moment of truth now comes in. After they did that, I was now anticipating they are now liquidity void here in forms of there's an fair value gap here, there's another fair value gap here, there's a slight one here. I want to see, and I sat on my hands to see how they work it. Work it in the sense that how they navigate those voids. They came all in there, the retraced came all in, then they did this, and then they started going up again. Working it, immediately they took out that last point. Immediately they took out that last point to invalidate all this fair value gap here. Immediately they took it out. I'm going in again to look for long trades again. Long trades to target what? 1, and then 2, then 3. That's it. Long trades to target 1 from here first. This point, this point, this point. So I took one here, then followed it all through, and then I took one on Friday. Yeah, I took one around there on Friday. And the main reason that triggered me into taking that one on Friday, because it's the same thing that happened here. So it's the same thing that happened here, where they failed to take out that liquidity point and then started going down. So London session, they failed to take out that liquidity point, went down on Friday, and then I anticipated New York session to obviously do that, and then New York came up to do that. I didn't participate in this lags big push, no. I just participated from here upwards. So let's break down this 1 hour into 15 minutes first. We'll first see the trade I took on Friday. I sent to the mentorship group, the mentorship class too. I just told them this was the particular buy side liquidity that I highlighted. This line. Why is that particular buy side liquidity highlighted? Because if you go back to the 4 hours, you see that this particular high, they missed it during London session. Let me make it bigger. They missed it. This particular high, they didn't get as close. They didn't take it out. They didn't go higher than it. They were just under it. So I anticipated London to do what? I anticipated New York to just come and drive through. And what did New York do? New York came down first. They came down before New York to fill out, to balance and imbalance, and then drive through. That was it. That was all they did. That was everything they did. So going back to the 15 minutes, after they missed this in the London session, and then they start gravitating down. My first point of contact was drawn into, would they gravitate into this and then send it back up? I was maybe thinking, okay, the London might eventually do this. But no, London didn't do that. And then coupled with the fact that if you look at our 4 hours again, there's an imbalance here. Let me clean this up, please. There's an imbalance here. I don't like having too much art on my chart. There's an imbalance here that they came to peak. So, looking at it on the 1 hour frame, it's not looking much of an imbalance, but on the 4 hours, there's an imbalance there. And then this is actually another one here, on the 1 hour, that they came all the way for. After they came all the way down, and then 9:30 open, you're going to see it's from 9:30 they started. Yeah, New York session came in. Prior to that, I first looked at here for London, whether London will send us to just take that out. They didn't, because London came all the way in. I was expecting pushback. Maybe I'd add like a pushback, taking somewhere around there. I was expecting retracement and then enter that trade to take this. So after they did this first, I was expecting, okay, this will come and give me that displacement that I need. It didn't give me that displacement to take out this eye very well. So I sat on my hands, and then I posted it on the group that, okay, I'm expecting New York to come and do that. And then New York came. New York came in. Look at that bearish setup. Every bearish setup, and look at how they all failed. This fair value gap here, they came all the way higher than the candle that is anchoring it. Failed. This fair value gap here, they came all the way higher than the candle anchoring it. Failed. So, 2 failures now. 2 bearish failures. I've told you, if the market is gravitating upward, looking for a particular liquidity point, if it's a buy side liquidity point, every of your bearish scenarios will fail. It's that simple. So immediately they failed again, and then they are so close to here. I'm not expecting big market retracements. I'm just expecting them balancing an imbalance and then gravitating. That was the main reason why I worked out for this, and I took my trade within this week. It was within this week that I took my trades. It was within this week that I took my trades. Within that week. And then taking my trades here, I just anticipated, just give me here. I didn't anticipate all these big moves. Anticipating, just give me here. Every of this week, I think I placed the trade here and I placed the trade here. And then waited for this. Going to the 5 minutes for that. The same thing I taught you. Expansion, retracement, more expansion, retracement. This is a retracement, it's not a reversal. Then expansion, then they did crazy consolidation, then more expansion till we got to that liquidity point. That's it. Expansion, retracement, more expansion, retracement, expansion, consolidation, then more expansion. I've taught you this. If I hide the chart, this is how it is. This is how it looks. The expansion, the retracement, more expansion, retracement, more expansion, consolidation, and then more expansions to get to that liquidity point. It's not rocket science. So, where are the opportunities? First opportunity is taking trading side. Yeah, you want to fine tune this. The fair value gap comes in here on the 5 minutes. So taking trades here and then putting your stop loss here. So you can take a trading side here, 701, put your stop loss at 699. That's like 20 pips. To target roughly 90 pips. Somewhere around there. And then you first take partial profit here when they broke out of here. Take partial profit here. Your stop loss should still remain there. The low here, they didn't take it out. And then the matching. After they took out the high here, they retreat, they balanced an imbalance. They balanced an imbalance here. All this leg coming down inside here. You can take a trade here. Your stop loss will be here. So you can take a trade at 704, stop loss at 701. That's like 30 pips risk for 60 pips, 2:1. It's like from 701, that's 90 pips for 20 pips. That's almost 4. It's like 2:1, which is still fine. It's really fine. And then they're matching to get to here. So it's not that it's hard or it's something that it's so crazy to do. No. No. That is just how it is. That is just how it works. That is just how the markets operate. And then running all the way here, they go to die, and you take off your trades and you're done. That's it. If you just have this for the week, you're a fine trader. Just this. You don't have to have the bulk of every move. Just have this. And you're fine. So, that is just how it evolves. That's how to use the weekly. To use the weekly and like fine-tuning your trades. Weekly bias, then down to the daily bias, and fine-tuning your trades. Target the liquidity point the weekly is going. That will be your bias. And then trade according to that. If your bias is bullish, then you don't have any business looking for a bearish setup. And if your bias is bearish, you don't have any business looking for a bullish setup. And then pair the time and price scenario into it. The sessions, that's when you trade. London or New York. New York morning or afternoon. You don't have to play Russian roulette with your trading where you just see every setup and then you trade every setup. Because the market just forms a lot of Judas swing. I can pick out a lot of Judas swing, a lot of bearish scenarios here. a lot of bearish scenarios in the sense that all this going down and then coming back up. This coming down, doing as if they want to go down with this, and then giving up the ghost, taking everybody out. All this going down, you start thinking maybe they'll come for this, run it back. All this going down, you start thinking maybe they want to clear out everything here. No. A lot. All this going down here, and then you think they want to clear everybody out, and then run it back. So that is how the market evolves. Just have a bias. Have a bias. Know the reasoning why your bias should work. It's not just picking red or green. That's playing Russian roulette with your trade. There are days where you'll be right and there are days where you'll be wrong. And if you don't have proper risk management with that, you just shoot yourself in the foot. Or as in this case, in the head. So have a bias, stick to that bias. If it's bullish, trade bullish scenarios only for the week. If it's bearish, trade bearish scenarios only for the week. It's until when you're more confident, then you can start looking for, okay, what are the counter trades? What are the counter days? It's that easy. This is the easiest it can be. This is the easiest it can be. You don't have to look for a very bogus setup. Have a bias. Know the liquidity point you want to target. Target that liquidity point. Look for your bearish setup or your bullish setup, whichever one your bias is saying. If it's a bullish setup, look for your bullish setup. Tag your trade according to that and follow it. And watch out for time. New York or London. Those setups will form around those sessions. During those sessions. It will form during those sessions. During those sessions. Because they are the ones that will show the true move of the day. They are the ones that will show the true move of the day, where the market wants to actually go for the day. They will show it. So they will form around and during those sessions. So it's not rocket science, it's not Aikinashi or Ichimoku's or giving one expensive name or one big name to a setup. I don't have a setup for my name. I'm not saying Panda setup. I learned it. It's everything that I learned that I'm dishing out. Okay, let's say I pick one name. Okay, this is a buyer setup. So it doesn't have to be a fancy name. And then you are not wanting new traders and beginner traders make it. They try proving ego. Once they learn one slight thing and then maybe just pan out once or twice, and then you haven't tried something for 100 times, 500 times, 1,000 times. You have only tried it once or twice and then it's worked. And then you think, oh, you have found the Holy Grail. You didn't even try it well. And then you start ego, that big ego. That, oh, I can trade better than this, I can do that. When you are in the market space, when you are trading, ego should be out of the door. I'm not trying to prove I'm a better trader than any other person. Fine. I'm not trying to prove I'm better than this person, because that's what is rife currently in the forex space. This one trying to prove this one is wrong, is the better trader. No, I don't need that. Any trader input is to make money. That's the main goal, to make money, to have a comfortable life. It's not to prove, oh, I'm better than this person, or I can trade better than this person, or this person is not as good as I am. No. It's just to make money. Every trade is set up just to make money. Every of the things you are learning is not to have bragging rights. I'm not teaching because of bragging rights. I'm not teaching because I have to show someone that I can do better than them. It's not everybody that can teach. Even I don't sometimes think I'm a very good teacher, because if there's a way I can just make you understand everything then and be done with it, that would be fine. So, every of this is just to make money. Just make money. That's the goal. You don't have to prove you're better than this person. Just make money. That is it. Just make money. So, with this live stream, we are concluding our class on liquidity and bias. This is the class that you really need a lot, even more than the other classes. The most important class that will rank above liquidity and biases, risk management, and we'll get to that. But this class, you getting this liquidity and bias very well. You being able to find where the liquidity is and know how your bias will form around that, set you 40 to 50% better. Because this is one of the most important classes. This, liquidity and bias. So I'll urge you again, if you haven't watched the video, to watch it. It's important. It's highly important. So take your time, jot things down. If you can't find out the liquidity, then you become the liquidity. It's as simple as that. And if you become the liquidity, you're just going to give yourself lots of mental fractures, because your money will go for it. A lot of things will go for it. Your mental state will go for it, and you start losing. And then it will seem as if you can't get this, and others are getting it. So, till next time, folks, have a lovely day.